Good morning, good afternoon, good evening from wherever you may be, and welcome to the webinar series on Islamic financing and public-private partnerships. My name is Sara Ahmed, and I am a PPP knowledge consultant with the PPP group of the World Bank based here in Washington, D.C. This webinar series is organized jointly by the Open Learning Campus and the Public-Private Partnerships group of the World Bank. This is the third webinar in our series on Islamic financing as a joint initiative with the Islamic Development Bank. The series focuses on increasing knowledge on Islamic finance within countries looking for infrastructure finance. The first webinar focused on the basics and relevance of Islamic financing to PPPs, followed by last month's webinar, which focused on the use of Islamic debt in energy sector projects. Today, our topic of discussion is addressing the use of Islamic debt in social sector projects. This presentation will discuss the case of a hospital PPP project where both conventional and Islamic banks are present as lenders. The case will present the transaction structure and the documentation involved in the structure that puts together these two types of lenders in one transaction, focusing on the Istisna'a mode of financing. So I'd now like to introduce our two main speakers we have today, who some of you may recognize from last month's webinar. First, we have Fida Rana, a senior PPP expert at the Islamic Development Bank. Fida has vast experience in project and infrastructure finance, credit risk, Islamic finance, and PPPs. He has led the structuring and financing of multiple infrastructure PPP projects across the globe and is currently leading the PPP origination and execution initiatives of the Islamic Development Bank in countries across Asia, Eastern Europe, Africa, and the Middle East. Fida has been instrumental in arranging, underwriting, and syndicating structured loans in a wide range of industries, including power, mining, oil and gas, and the social infrastructure sectors. We're also joined today by Hassan Idris. Hassan is a lawyer who works as in-house counsel with the Islamic Development Bank. Hassan acts as a transaction counsel for infrastructure and trade finance teams and has advised on a number of PPP transactions. Hassan has extensive experience in commercial litigation and has advised on real estate, infrastructure, securities, finance law, and alternative dispute resolution. He has obtained certifications in debt and financial management, Islamic finance, international environmental law, capital markets development, regulations, and risk management. I'm also joined today here in person in DC by our colleague from the IMF, Inutu Lukonga. Inutu is a senior economist in the Middle East and Central Asia Department of the International Monetary Fund. She has extensive training and operational experience as both a macroeconomist and supervisor of banks and security firms, and currently she works as the financial sector expert in the regional surveillance division of her department. Inutu has worked in over 22 countries and focused on Islamic finance issues as part of the Interdepartmental Working Group on Islamic Finance. She is also the author of the study Islamic Finance, Consumer Protection, and Financial Stability. So thank you, Inutu, and Fida and Hassan for joining us today. I would also like to introduce our PPP CCSA production team that is based in Washington, D.C., and from Tanzania, and that is Shamal Shukla, Rupinder Rai, Zichao Wei, Ejaz Ahmed, and Jeffrey Delman. And I would now like to quickly go over a brief agenda. We will start with the presentation from Fida and Hassan from the Islamic Development Bank, and then Inutu will share some of her thoughts and kick off the question and answer session and plan for the closing within the hour. So I'd like to now hand it over to you, Fida. Thank you.
Thank you, Sarah. Welcome everybody to all of you. As Sarah said, this is our third presentation webinar in a series that we started, and this is the one we are going to focus on Islamic finance in the context of hospital project. We took it as an example within the broader sector of social sector project. In our last webinar, we discussed about leasing mode of financing, also known as Ijara mode of financing. And today we're going to shift and discuss about Istisna mode of financing, which is another mode of financing. And together, Istisna and Ijara, these two are the most prominent tools widely used in the field of PPP as far as infrastructure finance is concerned. With that short introduction, as we did in the last time, we are presenting this webinar in the context of a real life project. And the project that we choose for today's session, the hospital project, PPP hospital project in Turkey, which was funded, as we will see in coming slides, by a group of multilateral banks and international commercial banks. Again, similar to the last presentation and the previous project, the power project, this project also features the presence of both conventional and Islamic lenders. So you will get the flavor of the coexistence or mix of conventional and Islamic lenders in the same PPP project that was done in the social sector, or more specifically in hospital or healthcare sector. With that background, uh, let me go directly to the country context. Turkey, about 10 years ago, started a massive program for healthcare transformation. Started around 2003. They call it transformation program. Under this program, the primary objective is to overhaul the whole healthcare system of the country in with the aim of bringing in efficiency and better utilization of the existing healthcare facilities. One of the components of this huge program that they are implementing in the whole country is PPP. So what they're doing is that they're implementing about 30 hospital projects, 30 to 35 hospital projects over next one decade until 2023. They want to complete these 35 new PPP hospitals with a total bed capacity of 40,000. And these hospitals are generally big hospitals. It's not a small hospital. They call it integrated health campus. Each hospital essentially are a specialized hospital with a lot of sub hospitals like child care hospital, oncology treatment. There's the lab facilities. There's a R&D facilities. There's also medical college. So they're calling it integrated hospital campus. So one of those projects that is the subject matter of today's discussion, a PPP hospital project, known as the Konya Integrated PPP Hospital Project. The name Konya is by name coming from the city of Konya, where the hospital is going to be constructed. Uh, it's a fairly big size, 838 bed altogether. The general hospital component, 420 bed, and the child care hospital component, which is 418 bed. The total cost for the project estimated as about 355 million euro, and it is to be funded with a debt equity ratio of 75-25. So a group of lenders, international lenders, as I told in the beginning, they joined their hands to fund this project. And this group of lenders include Islamic Development Bank, EBRD, BSTDB, Luxy Trade and Development Bank, those who are familiar with, and also commercial banks, international commercial banks, Siemens Bank and Unicredit Bank. All of them together provided 75% of the total project cost as senior facility, and the 25% coming from the sponsors. That was the funding plan. The project structure is a classical project finance structure, which you can see in front of you. And part of the structure is the project company or SPV. And this SPV going to enter into a number of contract or agreement with different parties in order to implement the project. Core of all these agreements, known as the concession agreement, in the context of this project, it is known as project agreement that was signed between the Ministry of Health and the project company. Of course, you can see on the top left the Idea Construction. That's the company that sponsor based in Turkey, who provided 25% of the equity. And the top right, you can see a group of lenders altogether. YDA also has a construction arm, very big. They are going to construct the project as well in the capacity of construction contractor, and there will be arm's length standalone construction contract, the capacity of construction contract. The services of this hospital, because when you run the hospital, you need a lot of services. These are subcontracted to subject matter specialist companies, many local companies, for example, who are expert in radiology, who are expert in maintaining the different equipment, hospital laundry services. To run a hospital, you need many services. So there are a lot of service providers, and all these service providers will be integrated through a coordination arrangement that we agree. One fundamental thing about this social sector project, the project we are presenting to you, is remember that when you talk about hospital project and what the government of Turkey did, they divided the services into what they call it core hospital or medical service and a non-core medical service. The core medical service, that means the responsibility of providing the healthcare from the perspective of the citizen or user of the hospital. When they will walk into the hospital, the doctors and nurses they're gonna meet are all remain the employee of the government of Turkey. So the government retains the responsibility of core medical services, and it will be provided through the government employed doctors and nurses. What the private sector is coming and implementing here is they're coming with the fund, they're mobilizing fund from the banks, constructing the hospital facility, procuring the necessary equipment, and over a time of 25 years, they will manage this hospital, they manage the building, they will manage and run the support services, including all the hospital equipment. So that's how the package is divided between public and private component. And that's why it's a very good model of public-private partnership. But the public retains or the government retains significant responsibility, which is the core medical services, where the facility management, facility construction, medical equipment are outsourced to the private sector. So with this model, the if you look purely from the perspective of the lender, or for that matter, from the perspective of the equity investor, the first thing they look into the financial viability of the project. And when they look at the financial viability of the project, one thing that comes to mind is the revenue structure. And this slide briefly explains the revenue structure of this PPP hospital project. And for that matter, this is the revenue structure that was used for all the other PPP hospital projects that are being implemented in the country. I spoke about 35 hospital projects that the government is planning to implement over 2023. So the revenue component, as you can see here, has got two big components, subcomponents. One is known as the availability payment, and the other one is the service payment. The availability payment is very similar to the capacity payment that we discussed in our last webinar. This is the fixed amount of payment the government of Turkey, through Ministry of Health, is going to make to the SPV or project company. Of course, subject to the meeting of certain qualifications that the project company has to meet on an ongoing basis. And this availability payment will take care of the fixed cost of the SPV, the debt repayment component of the SPV, as well as the equity return. On top of that, there is a service payment component. It depends on the service the hospital is going to offer. And when I say the service, it refers to the non-core medical service, because as I mentioned, the core medical services is with the government. It will remain with the government. The non-core medical services, that is the support services, uh, that will be provided by the private parties, this this revenue is tied up with that component. So taking this together, the availability payment and the service payment, these two together makes the whole revenue component of the project. And if you go further, if you look at the screen, if you go further down to or to the right, you will see the different subcomponents or breakdown of this revenue stream, which will not go into that details in today's presentation because of the time constraint. But this presentation will be uploaded soon after the today's session, and you can download it and look into the details for further learning. Now let's go back to the construction arrangement. The reason we're focusing on the construction arrangement, because when you talk about Istisna'a, Islamic mode of financing, that essentially focuses on the construction side, how the construction will be structured, funded, and monitored by the Islamic Bank. Construction arrangement that was agreed for this project was a typical lump sum fixed price turnkey construction contract, and it was executed on an arm's length basis with the construction company, which is again a sister organization from YDA. And the construction contract passed down all the responsibilities related to the construction of the project from the project company to EPC contractor. What is meant by this? The Ministry of Health signed the project agreement with the project company. They don't know who is the construction company, right? So the construction company comes into the picture down the road when the project agreement has already been signed. But the SPV or the project company is not a construction company. It's basically an SPV. They have to pass down the responsibilities that it inherited through the project agreement from the Ministry of Health to a party that can do this job. And the party here is the EPC contractor. So that's why the second bullet point, they pass down all the responsibilities related to the construction to the EPC contractor. Goes to the O&M arrangement, the operation arrangement. When it comes to when the construction will be over and the project will start operation, there will be an O&M company who will do the job required to run this hospital. And that O&M company, as I explained in the diagram, that there will be a subcontractor, number of subcontractors, O&M subcontractors, who will coordinate this subcontracting job in order to run this hospital smoothly. Similar to the EPC arrangement that was agreed with the EPC contractor and passed down all the responsibilities that the project company got from the government. In the same fashion, the project company also passed down all the O&M responsibilities to the O&M contractor. That is also one of the key features of the sound project finance or infrastructure project finance risk mitigation. to allocate the risk to the appropriate party who can best handle that. And the same principles we applied here, even in the case of a social sector project. Then it comes to the point of construction arrangement, how the construction arrangement was done in the context of an Islamic finance. And at this point in time, I will hand it over to my colleague Hassan, who is going to take into more details from the structure angle and the Islamic finance angle, that how Islamic finance was deployed using the mode of Istisna financing in the context of this. Hassan, over to you.
Welcome again to the continuation of the series on Islamic finance and with the PDP projects. Having had the background laid by Fida, we will continue to focus now specifically on the Islamic finance instruments used for IDB's participation in this project. As keeping true to the topic of the day, the mode of finance we're looking at is the debt instrument used in this regard. The concept of Istisna will be explained shortly, but before then, it will be important to highlight that under Islamic finance, it is required that any sale transaction on an asset needs to fulfill at least three requirements. First being the existence of an asset, and then the ownership of that asset. Whoever is actually selling the asset has to own it, and this asset has to be capable of delivery at the point of contracting. Istisna and Salam actually pose the exception to this general rule. Under Istisna, the asset is not in place, it's meant to be constructed. So what is Istisna? Istisna actually is derived from the word sana, which means construction, to construct or to manufacture. So in a nutshell, Istisna is actually a construction contract whereby one party requests another. A party called the seller actually undertakes to manufacture or construct an asset on behalf of a buyer, and this asset has to be agreed in specification for a price agreed upfront on a specific delivery date. In a way, this is actually a commission construction based on deferred payments and deferred delivery arrangements. IDB uses Istisna to actually enhance or meet the advanced funding and construction needs for projects in member countries. However, before we go deep into the project, it's important to locate Istisna within the general project scope. The starting point is to actually look at the schematics of Islamic financing. It is deliberately limited to only Istisna here because we have both conventional lenders and the Islamic tranche lender, which is IDB in this case. However, we would not discuss the other conventional documentation because the purpose for this presentation is limited to Istisna. The base document for this engagement starts with, as FIDA had earlier notified, is the project agreement, which is actually the concession agreement in this case between the Ministry of Health and the borrower. The borrower has dual capacity in this arrangement in dealing with IDB. In the first case, the borrower is actually the project company whom will undertake the task as agreed upon with the Ministry of Health under the project agreement. And in doing so, IDB and the project company will enter into an Istisna procurement agreement. Under this agreement, IDB will undertake to procure the construction and the manufacturing of the critical assets for the hospital, for the project company. Since IDB is not in the business of construction or manufacturing, it is only natural to actually subcontract or delegate the construction obligation to here, the project company, of course, the borrower, acting in the second capacity as the agent. Now, acting as an agent, IDB delegates all the responsibilities it has actually undertaken to carry out under the Istisna agreement through the agent, using the agency agreement as a tool. The agency agreement empowers the agent here, the borrower, to contract with the EPC contractor to actually carry out the task upon which the project agreement is based. So this is the general schematics. IDB undertakes to procure and then delegates the same duty to the agent, and the agent actually contracts this obligation with the EPC contractor. So this actually gives a seamless allocation of risk to the party that can best control this risk or compare it. We will take the Istisna'a agreement, then followed by the agency agreement, and another agreement embedded in between the two agreements. However, to start with, Istisna'a procurement, as we have explained earlier, this clearly mirrors the obligations that the project company had undertaken with the Ministry of Finance under the project agreement, Ministry of Health under the project agreement, in order to design and construct the assets. Here we call them procurement assets. The commitment of IDB, or Islamic Bank in this case, is limited to the commitment it has made within the general project size. So disbursements will be made on stage payment basis to the project company in this case. But the Istisna'a procurement agreement will typically cover the following items. And keeping with the Sharia requirement of Istisna'a, certain aspects of the agreement must reflect these items that we have listed. A clear description of the assets must be stated in the Istisna'a agreement. For this particular hospital, there is the health facilities, and there are also commercial and non-core health facilities. And these are clearly described in the EPC contract and also referenced in the procurement agreement. The Istisna'a price and its component must be clearly stated. The price here would be the aggregate amount of drawdowns or disbursements made by IDB to the project company. And it is actually limited to the commitment that IDB has made in this regard. But the price itself, during the construction period, the project company would make an advance payment consideration to IDB, which will be taken on account until the delivery of the assets. After the delivery of the assets, the price component will comprise the deferred payment consideration, which will be the aggregate of the total amount disbursed during construction period, which we'll call the cost price, and the relevant markup on that outstanding cost price. The timeline for the completion of the construction has to be clearly stated. It's actually because these assets are not present at the time of contracting, are supposed to be delivered in the future at a future date. So specifying a timeline is a key condition for the validity of the Istisna'a agreement, Istisna'a procurement agreement, without which it actually introduces an element of uncertainty or darar. So the timeline for completion mirrors the timeline also under the construction schedule in the EPC contract. So they are basically tied and made seamless. Compensation for delay in payment. Because construction actually have the risk of completion, it is expected that any delay occasioned as a result of the default of the EPC's contractor is also reflected here, because there is for this project there's 3 years granted for construction of the assets. So any delay in this actually have its own repercussion in terms of costs to the financiers. So the delay for completion would also be likened to the default interest provision that the conventional finance documents actually have. The difference here being that the compensation delay under Islamic financing, under Istisna'a, it's not, Sharia does not permit the bank to earn any payment made in consideration of any delay. So we have what we call a donation facility, where the payment made due to the delay would be donated to a charity dedicated for that purpose, but it cannot be earned as an income for the bank. Delivery of the assets could actually be either phased or actually at the end of the completion date. So delivery of the assets could be based on milestones achieved, and once milestones have been achieved, a partial delivery based on this progress made will actually be made to the bank in phases until the completion of the construction phase. Or at the final stage of construction, the asset title delivery is actually made to the bank. It is important to note that during the construction, the ownership in the assets lies with the bank, and so is the risk that is actually attached to ownership and the capital charge that actually goes with it. Now, since we have other financiers in the context of this project, The relevant portions of the Common Terms Agreement and the Intercreditor Agreement are reflected in this Istisna Agreement for seamlessness. The parts that actually does not agree with Sharia are qualified in the Common Terms Agreement and Intercreditor Agreement, especially places that has to do with, of course, default interest or interest requirements or other aspects that are not actually approved by the Sharia. That said, we also have the agency agreement. Since the bank, as we earlier stated, is not in the business of constructing assets, would naturally delegate this function to the project company. And after doing so, the project company is now empowered to select a qualified EPC contractor that would actually carry out those procurement obligations stated in the project agreement, in the Istisna procurement agreement. However, payments, this agreement actually is the financing, it's actually the tool for the disbursement. Through the agency agreement, IDB will actually make stage payments or so-called disbursements or drawdowns in the commercial sense, equal to the commitment made on its total financing in relation to the total project size. And this disbursement will actually be in phases towards the completion of the procurement assets. Generally, the agency agreement will cover some aspects that actually mirrors both the Istisna project agreement, the EPC contracts, as well as certain elements in the project agreement. However, they cannot be an agency without an appointment of an agent. So the appointment of an agent is, of course, the first step towards this engagement in this agreement. Because with the appointment of the agent assumes a different capacity. The project company assumes a different capacity as the agent, with clear responsibilities and obligations to this appointment. Partial assignment of the EPC contract. However, the EPC contract has been, through this agency, assigned to the project company. However, some of the benefits in the EPC contract, like insurance claims, are actually reserved or retained by the bank. That's why the partial assignment clause is necessary there. Because once you actually once you assign completely all of the benefits in the agreement, you may have to rely on the project company for the realization of any compensation events. So the stage payment procedure is also stated. The drawdown schedule actually also matches the drawdown schedule in the CTA, that's the Common Terms Agreement. Condition precedents stated in the Common Terms Agreement are restated in the agency because it is the agency that triggers the drawdown requests under the Istisna Agreement. Termination, of course, once the assets are delivered, the agency is terminated automatically, or when a termination date has been specified, except if there is a variation or an extension of time within which the assets can be completed. On the other hand, the termination event happens, of course, in the item we'll discuss later, which is the event of defaults. Now, it takes us to the event of defaults. There are events of default that are clearly stated in the Common Terms Agreement and the Istisna Procurement Agreement. These are equally restated for the utility of to clear ambiguity. This agency agreement must also come with the indemnities of the agent to the principal being the bank here, of carrying out the job, the construction of procurement obligations in line with best industry standards. So these indemnities are binding on the EPC contractor as well as the agent, in this case, the project company. However, the third agreement or document that features in the Istisna arrangement is not particularly a financing document. This is actually a document that is devised to actually take care of certain events that happen in the course of construction or project execution. That is because prepayment arrangements cannot be clearly defined and clearly stated in the Istisna procurement agreement. Once that is done, it gives an idea, it creates an idea of garar, or what we call uncertainty. This uncertainty as to pricing, because one, there will be a pricing fixed under the procurement agreement, and there will be also a default pricing based on either early payment or sort of prepayment. So Sharia does not encourage putting two prices in one document. That is why an early settlement memorandum has been devised to take care of this limitation. The reason why you cannot do that, of course, is because the discounts are applicable to any early payment instead of the weighted costs, which is Sharia prescription. And to do that is it is in the absolute discretion of the financier, so it's not supposed to be stated clearly in the Istisna'a procurement agreement. That way it becomes a contractual discount, and discounts are not supposed to be contractual, they are supposed to be discretionary. So we use the MOU to actually take care of any early payment obligations under the Istisna'a procurement agreement. Now moving to the issues you face. As we have highlighted earlier, this project is co-financed by both conventional and Islamic lenders, and there are issues that are bound to actually crop up in the course of structuring this project finance. And things that we need to advert our minds to has to do with the selection criteria for an appropriate mode of finance. And to do that, you would have to look at the nature of the asset or the availability of the assets. If the asset is available, then you may not have to do an Istisna'a project. You may just have to do a Murabaha, since it's actually available, it's off the shelf. But if it's not available, it needs to be constructed, you may want to consider actually Istisna'a, because Istisna'a permits construction of a non-existent assets. You will also have to look at the local law requirements. The local law, does it permit asset ownership, or does it even recognize Islamic financing? These are things you need to take into consideration before you structure Islamic debt to finance any social project or any project financing for that matter. Now, multiplicity of legal documentation. However, project finance is document heavy as it is. Having an Islamic tranche does not necessarily make it easier. It adds to the documentation burden or weight. Now, under Islamic financing, you will find out that, just as we've explained earlier, besides the Istisna'a agreement and the agency agreement, due to prepayments, you may not have the liberty of including that in the Istisna'a procurement agreement. So you would have to employ the use of purchase undertaking or sale undertaking, or you probably use a memorandum of understanding for early settlements. Sharia does not actually agree to combining two contracts in one. So the more reason why you see every document is rule specific or an activity based, agency based or construction based or prepayment based. So these are things that you need to take into also consideration. And this may even be more when you have more Islamic financier on the Islamic tranche. Now, the other aspect that is unique to Islamic financing in terms of structuring will have to do with the clearance that you need for any structure you adopt for Islamic project finance. In this case, the relevant international Sharia clearance is a condition precedent to the bank undertaking any financing. And one of those things you need to understand is there is no centralized Sharia board. You may find conflicting resolutions of different Sharia board concerning the structure. And this could actually impact on the possibility of taking part in the deal or delay certain aspects of timelines agreed upon. However, it is also important in seeking clearance that the borrower undertakes its own independent assessment and confirmation of Sharia compliance, because this is one of the requirements if a borrower wants to take part in Islamic finance. We advise the borrower to seek all the professional Sharia advice so that he's advised of all his rights, and then he makes that undertaking or representation to actually review the necessity of having a dispute that actually involves Sharia non-compliance. The other aspect that needs to also be looked at is the ownership versus pari passu basis of the assets on the Islamic finance components. Since IDB or the Islamic Bank would be financing certain specified assets under its name, and the ownership of these assets would truly be on the books of the Islamic Bank, it actually becomes understandable when the Islamic Bank actually wants to have priority in terms of those asset ownership. But in structuring, this is where you need to also have certain level of discussion, or you probably find disagreements with other commercial lenders whom would not want to have an exclusivity or sort of preferential assets allocation to Islamic finance. But justification is these assets are on the book. There is a huge capital charge taken on the books of the bank during especially the construction period for Istisna. So that actually becomes an issue. But typically, it is usually resolved through the pari passu sharing. The Islamic banks agree to share pari passu, but also takes the weight or take the burden of taking these assets on its books, all the same in compliance with Sharia. The treatment of certain fees, actually, you would realize that there are not all fees permissible under Islamic financing instruments. Fees like commitment fee actually are disputed by various Sharia boards. So the risk is there that an Islamic bank may put in a lot of effort in seeing the deal pass through, but something may go wrong along the line, and the risk is actually on you. You may not be able to actually claim any commitment fee after you have made that sort of commitment. However, Islamic banks and IDB sometimes, most times actually, in line with the Sharia Committee's recommendation, is to accept the commitment fee actually donated to charity in certain circumstances. In other circumstances, it is outrightly denied, and that can be taken. Fees like breakage costs and others are also contentious, but actual administrative fees and management fees or arrangement fees are actually allowed. And so these are things that one needs to actually contemplate in structuring any project finance based on Islamic concepts. The other aspect that has to do with the Islamic finance is the governing law. When you have conventional lenders and the Islamic lender or an Islamic financier, typically conventional lenders are comfortable with English law or the New York law or the other laws that they actually tested and sort of comfortable with. But under the Islamic tranche, we typically, in agreement with the concept itself, base the contract in line with Sharia. So the governing law is really Sharia, and since Sharia is not necessarily a substantive codified law, certain uncertainty prevails in the negotiations with conventional lenders. And so what typically happens is these provisions, when we say, sometimes Islamic banks agree to include the provisions stating that the contracts or the agreements are governed by English law, but actually subject to the principles, so long as they are not in conflict with the principles of Sharia. However, in certain court cases, we've had precedents where courts, or in Shamil's case, for example, that I cited there, if you want to look up the facts in Shamil's case, where under the contract, English law was said to be the governing law, but as long as it's not inconsistent with Islamic law, and that provision was held to be unenforceable, and the agreement was actually governed by English law. What we have understood after reviewing this case is the fact that at some point, judges, maybe English judges or the New York courts may not be conversant with the Sharia principles. And this is because even the Sharia principles have divergent interpretations. So standardization comes here to sort of become the apparent solution to having Sharia requirements recognized by the courts. However, with IOFI guidelines on Sharia for various Islamic products, this would have actually been the case if necessary reference was made to see IOFI guidelines on Sharia concerning Istisna. The English judge could look up Sharia standards, which are defined based on certain methodology, and actually determine whether there is a conflict in the circumstance. So typically these are considerations, in addition to others that time would not permit us to actually delve into, that you look into in structuring Islamic project finance. This cumulatively actually gives you a wider picture as to what to expect or what to actually do at certain stages in this project packaging. Thank you.
Thank you, Fida and Hudson, for this very engaging presentation. I'll now hand it over to Inutu for your expert remarks and to kick off a few question and answer.
Thank you, Sarah. And thank you, Fida and Hassan, for a very comprehensive presentation. Good morning, good afternoon, good evening to the participants. Fida and Hassan has provided you a very comprehensive analysis of the use of Istisna in PPP projects. So I'm going to take you to a different angle, which is the macroeconomic and financial stability aspect. When we look at starting from the advanced economies to emerging and developing economies, we see a big backlog of projects that are needed to drive growth. And the social sectors in many of our member countries have deteriorated due to insufficient investment. So closing this infrastructure gap, including in the social sectors such as hospitals, will certainly help foster higher economic growth, and we welcome the involvement of the private sector in the infrastructure financing. Also, in many of our member countries, public sector investment has been the main engine of growth. And with the declining commodity prices, particularly the recent slump in oil prices, fiscal positions have weakened tremendously. And as a result, most countries are now scaling back their public investment with adverse consequences for economic growth. The participation of the private sector in infrastructure financing has therefore become even more important. And Istisna is therefore uniquely suited for financing infrastructure projects and for involvement of the private sector. However, when we review the balance sheet of the banks, we find that Istisna financing is used in very, very few countries. And so far, we found Malaysia, Kuwait are some of the few countries that have actually used Istisna. But even in these countries, when you look at the size of the balance sheets, you find that the share is very minute. And if you look at the data compiled by the IFSD, you find that the share is as small as 0.4%, which is very, very, very small. Therefore, what we see is further efforts will be needed at creating an enabling environment to facilitate the use of Istisna and other instruments suitable for financing infrastructure projects, and also to facilitate the public-private partnership on a larger scale. The Istisna which we are discussing today has some unique risks that cannot be addressed by legal or regulatory frameworks designed for conventional products. And one of the main risks inherent in an Istisna contract is the rate of return risk. This is the risk that the cost of production, funding, could increase in the period of the Istisna, and in which case the manufacturer or the Islamic financial institution may not be able to pass these costs on to the purchaser or to the borrower. And therefore, the development of Sharia mechanism to hedge price risks will be very important to facilitate the greater use of Istisna. There are also operational risks related to the possibility of potential discrepancies between the specifications agreed by the parties and the actual specification upon delivery. Another issue that one has to take into account is the long-term nature of the infrastructure financing. There is a high risk there that the banks could have maturity mismatches between the assets and the liabilities, which could increase liquidity risks. These unique risks therefore require that the legal and regulatory frameworks have to be adapted to the specifics of Islamic financial products. At the IMF, we are currently undertaking a survey of regulatory frameworks for about 50 countries. In countries which have significant segments of Islamic finance, we have already received responses from half of the countries, and the results showed significant disparities in the progress made by countries. Generally, we find that the countries are increasingly adapting their regulatory and supervisory frameworks, taking into account the specificities of Sharia-compliant products. But there's still a lot of countries where legislation for Islamic finance does not yet exist. In addition, in jurisdictions where Islamic banking and conventional banks operate side by side, taxation on some of the products remain an issue. For instance, 22% of the respondents indicated that depreciation of Hijra assets, which was covered in the last webinar, are not allowed. and the jurisdiction levy different taxes on the SPVs. In the case of the banks, given the long-term nature of the infrastructure financing, there will be need for banks to raise long-term financing. And in this context, the development of deep and liquid sukuk markets will be very important in order to facilitate the private participation and the use of Istisna as an instrument. In some of the member countries, we found that the legal framework for issuing sukuk is yet to be developed, and this can hinder the financial institution's ability to manage liquidity risks arising from this maturity mismatches which between the assets and liabilities, and therefore can impede the participation in public-private partnership to finance infrastructure. In conclusion, we therefore see a need for greater efforts at tailoring the regulatory and supervisory frameworks to cater to the specifics of Islamic finance will be very important in facilitating the partnership, the participation of the private sector in economic development. With these few remarks, let me now hand over back to Sarah. But before I do that, I'd like to pose one question to Fida. What do you see as the main reason why Istisna has not been used by banks in a larger, much more than currently?
Thank you, Nito. Very pertinent question and good question, and especially in the context of PPP projects. When we look at our portfolio of PPP projects that we have done so far in different sectors, power, transport, we have just mentioned about social sector projects. Majority of the projects are done using the mode called leasing, ijara, rather than Istisna. And the first and foremost reason that I'll give from a business perspective is the pricing issue, which Hassan has already alluded to. And you have mentioned also very correctly that Istisna financing is a very long-term financing, the project financing or infrastructure financing, long-term financing. We are talking about 15 years to 18 years, in some cases 20 years funding by the banks. By the very nature of Istisna financing, the pricing of this financing has to be fixed throughout the whole period. So basically at day one, I am fixing the price of my facility for next 18 years. It may create a gap where my price is fixed for the next 18 years, 20 years, but my sources of fund, where I'm raising the fund, that might be variable. And if you look at the practices of conventional banks, almost all the conventional banks, they provided variable rate funding, which is basically a LIBOR-based funding. Istisna does not allow us to give variable rate funding. The variable rate funding we can apply in the case of leasing. And from a business perspective, that's the first answer I can give, is the pricing methodology that works in favor of lease financing. And lease financing goes very well when there are multiple lenders involved in a project, along with including the conventional lenders. Thank you.
Thank you, Fida. I'm now going to pose some questions that we've received during the registration and also combine it with one question we've just received. So this question is actually for Hudson. In what cases is the Istisna structure preferred over the lease structure? And following up that is a question we have from one of our participants, Abdullah, is Istisna best used for short to medium term projects, and what would be, for example, the best mode of financing for a highway?
question calls for comparing Ijara and Istisna in terms of their efficiency in project finance, especially. I will take the second question first before the first, meaning is it for short to medium term? Typically, it's for medium to long term. Typically. And now, but let's look at it in this context located. For IDB as a multilateral, IDB is involved in large-scale infrastructure projects, and so you would see this as necessarily a mid-term to long-term financing, because of course the construction period is quite between say 3 to 5 years depending on the scope. On the other hand, if you look at Istisna from a commercial Islamic banking point of view, it could actually be used as a short-term to medium-term, especially when it actually involves a retail-based housing construction, which would not take more than a year actually to get it constructed. Now, what happens afterwards would be the mortgage arrangement, right? Now, if, depending on the countries and the nature of resource matching, mobilization and deployment of the individual Islamic bank, you would find out that if they have short-term deposits to finance Istisna, naturally the tenor will be shorter. So you would find it from the short to mid-term for a national, Islamic bank within a territory. But for an IDB, which actually has a developmental mandate, this is a long-term product. As FIDA has alluded, it's for between 15, sometimes to even 20 years. For a highway project definitely depending on the kilometers coverage and the nature of the project area, it may take up to roughly that long to be able to, especially with the tolling, so that you can actually generate necessary revenue for the repayment. So it has to be structured on a long-term basis. And this is a different, spec if you look at it. Highway is more of a social infrastructure, economic infrastructure. And the housing, particularly for a retail Islamic bank user or customer, is basically a retail product which could be structured on a short-term to long-term basis. Now the difference, taking the first question, the difference lies in, firstly, the rate. While in Istisna, the rate is fixed, it's a seal product. But for Ijara, on the other hand, the rate can be or typically be floated through the life of the Ijara term. That is the first difference. And when is it more suited? Two things happen. During the ownership of the assets by the Islamic bank, during Istisna only happens within the construction period. And after the construction is completed, the sale takes place immediately and the transfer of the assets from the books of the bank onto the customers happen immediately. On the other hand, in Ijara, it takes the whole stretch till the end of the Ijara period. And so you have the assets on your books and the risk on the assets throughout that period. So typically, two things you consider also. One of the things that is key to either choosing Istisna or Ijara has to also do with the enabling legal or regulatory environment. For highway projects, as Abdullah has asked, this has to do with the legal requirements of the country. Does the country recognize ownership of the assets? If the country recognizes Ijara, then Ijara could be used in a highway project. But where the country is reluctant to actually give the ownership, because the ownership lies with the bank through the asset Ijara term. If that doesn't happen, then of course your recourse will be to do Istisna, which limits your ownership just within the construction period. Thank you.
Thank you. Thank you, Hudson. We actually now have another question for Inutu that's just come in. And it's asking Inutu if you can highlight, the macroeconomic implications for LMIC without a legal and regulatory framework for Islamic finance and the intent to issue sukuks.
Thank you. One of the challenges of without the legal regulatory framework, it makes it difficult for the countries to issue sukuk, and therefore, which means for the banks, their liability side will have short-term, the liability side will have short-term financing. The funding side will be short-term, and you end up with maturity mismatches with on the asset side, which is Hassan has mentioned already. On the asset side, the projects take a long time, and therefore, if you have such maturity mismatches, it becomes problematic for the banks. And it's for this reason that you actually need the legal framework for sukuk so that you can issue long-term sukuks and ensure that on your liability side, you are also matched. You are financing your long-term assets with long-term liabilities. That mainly is the main concern. It's more of a financial stability concern. In terms of the macroeconomic implications, Sukuk, because it's asset-based, it is more suited for financing economic projects and infrastructure, which can actually support growth. So that's the main reason why having a legal framework for Sukuk is very, very critical has got such significant macroeconomic implications.
Thank you, Inutu. And then I think we have time for just one more question. And I'll ask this to FIDA, just to kind of, and I think it's also a good question to close us off. But FIDA, as Islamic finance is making inroads into social sector PPP projects, what is your assessment of this trend in the next 5 to 10 years' time? And also, Inutu or Hassan, if you would like to chime in with your thoughts on this after FIDA has answered, that would be wonderful.
Thank you, Sarah. You see that from Islamic finance practice, you look at the projects that are being funded by Islamic banks, infrastructure projects to the mode of PPPs. A vast majority are essentially energy sector projects. That constitute the bulk of the PPP type projects. And then it comes to transport sector projects, toll roads, bridges, hospital, airports, depots. Social sector projects are relatively a new addition in the universe of Islamic finance or in PPP. So what we see that it's the beginning of the beginning. This journey started in the social sector projects. Hospital sector we started in Turkey. It's one of the member countries, OIC member countries. We will see most likely, we are expecting to see this model being replicated in some other OIC countries. We are in talk with some of the governments of other countries, and we can see a lot of interest to replicate that model and customize it to the country context. So there will be projects coming into this sector. And I think beyond that, over time, we may see social sector projects going beyond hospital and encompassing fields like education and others. So that's what we can see the trajectory in next 5 years, 10 years time. Thank you.
All right. In addition to what FIDA has said, traditionally, social projects or social sector projects traditionally are the exclusive preserve of governments, and citizens look up to the government for the basic provision of healthcare needs, education, and other needs. But due to fiscal constraints, and certain budgetary realignments in certain countries, especially developing countries, it has become critical that the government devise a sort of a mechanism that would enhance their capacity to deliver on the social goods. And to be able to do that, private sector becomes a critical development partner in this regard. which might entail the government actually providing this at subsidized rates to the people. However, it will be able to leverage on the efficiency gains with the private sector and have these things done within the shortest possible time and generating the needed returns per se, because today the government alone cannot be able to shoulder all this responsibility. So it actually has provided certain level of deal flow between the government and the private sector. Here, the opportunity is critical to private developers, Islamic banks, conventional banks to actually be active partners in the development of this critical social infrastructure. So we see that in the near future. In fact, we have witnessed this growing in terms of the trend of requests we have, and then we see this will incessantly be louder as time goes further. Thank you very much.
Thank you, Hassan. And Inutu, you have any last final thoughts, or?
I think the questions have been comprehensively covered.
Thank you. I think now we are, running a little bit over the time, so I'd like to thank FIDA and Hassan, Development Bank, and Inutu from the IMF, and as well as the participants for your patience. And you will be able to download the presentation and view another recording of it tomorrow. And if you could also please kindly fill out the survey on your experience through the PowerPoint. We would greatly appreciate it. Thank you very much and have a great day.